Good afternoon and welcome to today's webinar where we will be discussing the highlights of the Credit Funds Forum Ropes & Gray hosted in New York a few weeks ago. The Credit Funds Forum was so well received that we had many people request that we provide some of the key takeaways for those who were unable to attend, and that's what we're going to do this afternoon. You will have the ability to send text questions to us using the questions box at the bottom of your webinar screen, which we will address at the end of the webinar. CLE information will be provided at the end of the webinar as well. Before we begin, I would like to take a few moments to introduce myself and our other presenters for today's webinar. I am Jessica O'Mary, an investment funds partner at Ropes & Gray, and I have with me today Securities and Futures Enforcement Partner Eva Carmen, Finance Partner Allison Gow, and Tax Partner Jim Brown. We are going to discuss today the key issues, trends, and opportunities that came up during the Credit Funds Forum hosted by Ropes & Gray. The event included several panels that covered the following topics: tax, structuring, conflicts, regulatory issues, as well as challenges and opportunities in deploying capital. The discussions at the forum were based on a survey that Ropes & Gray commissioned from DebtWire of 100 senior professionals at credit fund managers, addressing key market, tax, structuring, and conflict issues relevant to credit funds clients. The resulting report is getting phenomenal feedback from lawyers and business people alike, and you can access a copy of the report through the Resources tab of this webinar. So moving on to a discussion of the topics that were discussed at the forum. I think one of the things people have been most interested in is the conflicts involved in credit funds. Eva, based on your experience in the SEC enforcement space, what would you highlight for our audience today as the key issues addressed in this area at the forum?
Thanks, Jess. There were several key takeaways from our panel on conflicts. First, it's important to understand that the SEC staff is currently very focused on reviews of credit funds. The SEC tends to review types of advisors in waves. They looked at some credit funds about 2 or 3 years ago during their initial run through private equity firms, but they moved away from them relatively quickly. We've seen about 60 exams in the past 4 years, and so in that context, it's clear to us that they are now back and with far more knowledge about how the private fund industry works and with far more sophisticated understanding about how potential conflicts can arise in this space. Accordingly, the most important key takeaway in this area is to prepare early, long before the SEC staff shows up for the exam. In preparing, preparation should be focused on how the SEC itself looks at the issue, namely through the lens of 206 of the Advisors Act. Now, 206 of the Advisors Act is the breach of fiduciary duty section of the Advisors Act. It is a departure from the SEC's typical way of reviewing many issues through the regular view of fraud in the sale of securities. 206 addresses issues that arise after the sale has occurred. In this context, the way that the SEC approaches these questions across the board for conflicts is by asking 2 questions. Is there a potential conflict, and was it adequately pre-disclosed? So those are really important because they enable you to assess potential conflicts across the spectrum in this space. So is there a potential conflict, and was it adequately disclosed? In this regard, pre-planning should be risk-based around the following types of issues that come up frequently in the context of credit funds. One, and probably the most important, is investing alongside affiliates which are investing in different levels of the same capital structure. The other issue that comes up relatively frequently is issues associated with management of MNPI and cross-trading. Also, allocation of fees and expenses have also been an issue.
Thank you, Eva. Eva and Allison, one result of the survey that was interesting is that it's clear that managing conflicts is not a one-size-fits-all approach, and that managers are using a mix of methodologies to manage conflicts. So, for example, voting proportionately to other creditors in a distress situation was a very common result shown in the survey, with 62% of managers using this technique. In contrast, only 8% of managers said that they attempt to resolve conflicts related to distress situations by not lending to affiliated portfolio companies that are distressed or stressed. Did you find this surprising?
No, Jess, I am not surprised that only 8% chose not to lend to affiliates that are distressed. The reality is many advisors have established credit arms for the purpose of investing in their portfolio companies. They see it as a win-win to be able to invest in companies they know and to be able to help their equity investors by supporting the portfolio companies with lending. The distressed context obviously raises additional conflict issues and concerns, but in our experience, and I think is shown also by the survey, managers have found other ways of addressing the conflicts relating to investing in distressed portfolio companies. The survey showed that nearly 80%, which is such a huge number, but nearly 80% of respondents limited the amount of a tranche of debt they would hold in an affiliate to less than 20 to 25%. There were even managers that limit their holdings 5 or 10% or less of the tranche of debt. So going back to the two questions you have to ask, is there a conflict and was it disclosed? Here there's clearly a conflict whenever you have the circumstance of investing in more than one layer of the capital structure, but firms are mitigating the conflict by limiting the amount they take. Moreover, they're doing this in conjunction with disclosures, which puts them in a position to achieve what they're hoping to achieve while still staying on the right side of 206.
Yeah, I agree, Eva. In fact, these self-imposed limitations mirror an approach to PE sponsors and their affiliated debt funds that have become quite common in credit facilities. Stepping back, lenders are not keen on having affiliates of a PE sponsor that owns their borrower being part of their lending facility. Lenders are concerned about the sponsor's dual role of having an inability to influence consents and waivers under credit facilities, but also being motivated to favor the equity. Since the last downturn, when PE sponsors saw real opportunities in acquiring debt of their portfolio companies that was trading at depressed levels, it has become common for PE sponsors, and in some cases their affiliated debt funds, to have the right to become lenders, but subject to limitations in the form of maximum holds and voting restrictions. These limitations are designed to keep PE sponsors and their affiliates from having undue influence in restructuring by affecting lender votes.
That's very interesting, Allison. Can you talk a little bit more about the significance of being less than 25% or 50% of a tranche of debt from a voting perspective?
Sure, absolutely. Outside of bankruptcy, most credit facility amendments can be affected by a majority vote. The exceptions are reductions in the interest rate, maturity extensions, and other so-called sacred rights that require the consent of each affected lender. So generally speaking, if lenders holding over 50% of the debt in a facility are willing to waive financial covenants or make it easier to incur debt or to permit money to be distributed to equity, they can do that. The significance of the 20 to 25% thresholds arise from voting standards in bankruptcy restructuring. In a bankruptcy proceeding, the threshold for a class of lenders to accept a plan is 2/3 of the amount and over 50% in number of lenders that actually vote on the plan. So a lender that holds over 1/3 of the claims in a class can actually block that class from accepting a plan. For this reason, lenders often insist that PE sponsors hold less than this blocking percentage by a comfortable margin, hence the typical limits of 20 to 25%. These restrictions on how much a sponsor affiliate can own of the debt are often bolstered by requirements that the affiliate vote in the same proportions as third-party lenders. Credit fund affiliates of the PE fund might be exempted from these limits, particularly if separately managed, though.
Thanks, Allison. Eva, another conflict that frequently comes up is the issue of whether to have an information wall and how to manage MNPI for managers that have both public and private investing businesses. So we asked our survey respondents about this, and 42% responded that they have an information wall currently in place, while 58% said that they do not. But an additional 34% said that they used to have an information wall but had taken it down. What do you see in your practice, and what are your key takeaways to our listeners regarding information wall issues?
Yeah, well, we do a lot of work with information walls, and what the survey found was actually consistent exactly with what we're seeing, both in terms of the percentages that have walls in place and even this concept of changing after a wall was put up. And I think at heart is the fact that many believe that they add the most value to their investors by not having a barrier, so that information can be shared and the investors can get the benefit of that. It clearly can be done. The key questions, though, are whether you have an adequate policy in place, whether your procedures, in fact, fit the structure of your organization and the practices in your organization to ensure that they are tailored well enough to meet the obligations of the policy. And from my perspective, in dealing with OC on insider trading related issues, I think that one of the most important things that can be done and that is being overlooked a little bit these days is training. So really training people on both the public and private side well, and really getting all people who potentially touch MNPI to understand the importance of involving compliance and making sure that compliance is aware when MNPI comes through the door, making sure that they understand the policies and procedures, and making sure that if it happens, they are able to describe to the SEC, at least in a relatively general way, how the policy works. In fact, I will note that in the event that people are more interested in learning more granular detail about our views on the management of MNPI, I encourage people to pop onto our site or go onto iTunes and look for one of the ROPES podcasts. We have a whole host of podcasts addressed at special credit fund issues, and we recently released one relating to this topic.
Thanks, Eva. And so for the benefit of our audience, could you also address what's new in terms of the SEC conducting exams of credit funds?
I am happy to do so. And there are a couple of new things. So if you haven't been examined in the past 2 years or even in the last year, there are a couple of things that you should be aware of. One, particularly with regard to credit funds, there is a new request relating to trade blotters. So historically, the SEC had some flexibility if your system did not spit out trade blotter information that was a perfect match with how they wanted to get the information. Those days have changed. In the past 2 months, we've seen that the SEC is adamant that the trade blotter information come in a specific format. This is because the SEC has spent a tremendous amount of money building out a massive database that enables them to use trade blotter information both to look at potential insider trading issues, but also to watch for cross-trade issues. So if you haven't seen the recent request for trade blotter information, feel free to reach out to us. We're happy to send you the verbatim copy of what they're looking for so that you can potentially do a run. Even very sophisticated firms have had some difficulty generating the information quite the right way. So that is a new point that is important to be mindful of. The other thing to be mindful of is that the SEC is kicking off exams with very lengthy calls. This enables them to be more efficient once they get on site, so some exams are shorter, but you should be mindful of the fact that soon after you get the letter, your first call letter, you're probably going to have to be on the call with the SEC at about day 20 for up to 3 or 4 hours explaining how your business works. The last note that I will make is there is an increased request for emails. So to the extent that you do not have an enforced policy about not using emails for personal purposes, now is a good time, because when the email request comes in, other than a privilege pool, all emails go in, and personal emails that are in any way questionable can really influence how an exam goes.
Thanks, Eva. So now I'd like to move on to discuss one of the other panels at the forum, the Tax and Fund Structuring panel. This panel was largely focused on how to structure credit funds to address ECI issues related to U.S. loan origination. Jen, as a partner in the tax group, would you give us a very brief description for the benefit of our listeners of what the ECI issue is, as well as the main approaches to addressing ECI and credit funds in the market today?
Sure. ECI stands for Effectively Connected Income. That's shorthand for income effectively connected with a U.S. trade or business. Non-U.S. persons are subject to tax on ECI in the same manner that U.S. taxpayers are subject to tax on their regular income. And so because credit funds are directed to a significant extent to non-U.S. investors and to U.S. exempt investors who invest through offshore entities, it's important for the funds themselves to be structured in a manner that avoids recognizing ECI. And ECI does not result from trading in stocks and securities, because trading in stocks and securities is not treated for this purpose as a U.S. trader business. However, loan origination, if conducted regularly, does result in ECI because it is treated as a U.S. trader business. And if it is conducted by the advisor as agent for the fund, the advisor's activity will be imputed to the fund, and as a result of that, the fund treated as in the loan origination business. So a number of strategies have been developed to protect the fund from recognizing ECI. None of these strategies is perfect. They all have their the shortcomings, but the ones that are most common include season and sell, treaty structures, insurance dedicated funds, so-called mezzanine funds, whereby the fund is not treated as in a trader business because it does equity-like investing, business development companies, U.S. blockers, which basically concede the U.S. tax and avoid and protect the non-U.S. investors from direct taxation, but they still bear the U.S. tax, and so-called vertical seasoning, which is a sort of a related structure to the traditional season and sell.
So, Jim, one of the first strategies you've mentioned was season and sell, or horizontal seasoning. Can you briefly describe for our audience how a program might work with this strategy?
Sure. So season and sell is probably the oldest strategy that's been used. It became relatively common in the mid-late 90s, and it involves brother-sister funds. The first fund is actually engaged in the origination business, and it is offered to investors who are indifferent to the fund being engaged in that business. And so those would include U.S. taxable investors as well as U.S. exempts who do not treat themselves as subject to tax on unrelated business taxable income. And those would include, for example, state pensions. The second fund, the sister fund, would be the fund that is offered to those investors who seek to avoid recognizing ECI. And the way that the season and sell structure basically works is that the origination fund, on its own behalf, acting as a principal and not as an agent for the second fund, originates the loan. It holds the loan for a period of time, the so-called seasoning period, and that traditionally was 90 days, but in many cases has been shortened to a fewer number of days. After the seasoning period, the other fund that's offered to the non-U.S. investors would purchase the loan at fair market value, and there are usually some other features to the fund structure that would help establish that the fund is acting on its own behalf and that the originating fund was not acting as agent for the second fund in the origination process. And some of those additional features may include, having an independent third party that validates the valuation of the purchase. It maybe requires third party approval of the purchase itself. It may involve separate teams of the investment advisor that act on behalf of the respective funds. And there's a good range of variety in how fund structures approach that issue, but all of them are aimed at establishing that that the originating fund is not the agent of the purchasing fund.
Thanks, Jim. So Eva, maybe I'll loop us back a little bit to something you addressed at the forum, which is inherent in the idea of a season and sell strategy between two different client accounts is the idea of cross-trading issues and related valuation issues. Can you just talk a little bit about how you think about cross-trade issues from an SEC and conflicts perspective for our audience?
I'm happy to do so, and it's a great way just to reinforce this concept of the two questions. Is there a potential conflict, and was it disclosed? Those two rules can go really far. I always encourage people to put a Post-it with those questions on their desktop because it applies to the cases that the SEC brought in the past, and it will apply to how the SEC is looking at these conflicts issues in the future. So the first question is clearly they would consider any kind of a cross-trade to be a potential conflict, which gets to the importance of disclosure here. So it's relatively acute in the context of these horizontal season and sell strategy funds because at the heart of those strategies is the concept that this may occur and therefore will occur and therefore it is well disclosed. But this same concept applies across the board with regard to credit funds that may be involved in potential cross-trades. So it is important that to the extent that the prospect of cross-trades is something that may happen, that it is well disclosed in the documents. And in terms of ensuring that you really survive an exam, the SEC unpacks these by first looking at the disclosures, comparing those back to the actual policies and procedures that are in place to test both whether the disclosure goes far enough in terms of what's intended by the plan for the cross-trades or the prospect of cross-trades. And then they will drill down on the question about whether or not the valuation aspect of this has been handled in a manner that's consistent with whatever disclosures were made about the valuation policies. One thing that some people do, which I do think you get some credit from the SEC for, is to use third parties in your valuation process to ensure that there is an added layer of potential reasonableness. The one place that we've in particular seen people get in trouble with regard to valuations is when they stray from their stated policy or procedure or methodology in manners that were not disclosed to investors.
Thanks, Eva. So, Jim, I think now going back to this idea of fund structuring in the U.S. loan origination context, I think we have seen for a while now a large interest in clients that we talk to in using treaty structures to address loan origination. But the number of pooled vehicles formed in so-called treaty jurisdictions still lags behind other types of strategies. Our report supports these general observations, namely it indicated that 64% of managers were looking at treaty structures, but that most were in the context of bring your own treaty or single LP funds. Can you give our audience some background on treaty structures and your thoughts on what explains these results of the survey?
Sure. So the treaty structure works basically on the basis that under all U.S. tax treaties, residents of the non-U.S. country or the foreign country are able to have their activities conducted on their behalf through an agent, and the agent's activities will not be attributed to it so long as the agent is an independent agent acting in the ordinary course. So that's a principal benefit under all U.S. tax treaties, and the treaty structures rely essentially on that benefit. And so the simplest version of the treaty structure would be that an investor is a resident of a treaty country and hires the U.S. advisor to act on its behalf. And if the advisor is acting in the ordinary course as an independent agent, its activities in the U.S. will not be attributed to the investor, and none of the income resulting from the activity, including loan origination, would not be treated as ECI. From that idea developed the so-called bring your own treaty fund structure, whereby a number of investors, each of whom is entitled to treaty benefits under its own treaty, would invest in a pooled vehicle, and the pooled vehicle would then hire the U.S. advisor, and each of the individual investors would be entitled to treaty benefits under its own country treaty on the basis that the pool itself is treated as transparent in the home jurisdiction of that investor. And so there's, in that case, very little or less question as to whether the advisor is acting as an independent agent, and that the pool itself is separate from the advisor and not the alter ego of the advisor, because you're really relying on the treaty of the investors themselves. From that idea, developed this concept of the pooled fund, whereby the fund itself is treated as the treaty resident. And under that structure, it has the advantage of permitting investors who are not themselves in any treaty jurisdiction to invest in the pool, and then the pool would treat itself as the treaty resident. And under and typically those pools would be organized in either Ireland or Luxembourg in a manner that avoids local tax in those jurisdictions. And then the pool would engage the advisor, and the advisor again would act as independent agent. A critical feature of that structure, however, is that in order for the fund to be treated as a good treaty resident in those jurisdictions, it has to have greater than 50% U.S. ownership or ownership of the local country. But because there aren't a lot of Irish or Luxembourg investors in these structures, typically most of the funds just rely on U.S. ownership. And in those structures, there's sometimes concern that the fund itself is not really independent, and that it is almost an alter ego of the advisor. And so there are a number of features of those funds that help to support the conclusion that the fund is not the alter ego of the advisor. And some important, or some features that are developed there include the fund investors being permitted to terminate the advisor on a certain amount of notice, the sponsor not investing in the pool, instead any co-invest would be done side by side with the pool. Because the sponsor avoids having equity in the pool, that the compensation to the sponsor would be structured as a fee instead of a traditional profits allocation that's a carry. Usually there would be an independent GP of the fund, and usually independent boards, and that the individuals that are responsible for the activities of the GP and the board would themselves have expertise in the area so as to be able to evaluate the performance of the advisor. And then in addition to those, there are other issues that usually come up in the treaty structure as well, which include, for example, the lenders typically have to be U.S. in order to meet the limitation of benefits clauses of the treaty, and then there are even more detailed requirements that are typically have to be adhered to. So it's a quite complicated structure, but it has the significant advantage of avoiding these cross-trade issues that are present in the season and sell, and it also provides the big commercial advantage of allowing all the investors in the fund to participate economically in the same manner, so that any income captured or represented from the loan origination process itself can be shared across all investors, and is not located in only the fund that's designed for U.S. taxables, which is the case for the season and sell structure.
Thanks, Jim. So the survey also showed increased interest among managers in the use of blockers to address ECI, given changes in corporate tax rates. However, this did not seem to be the experience of our panelists. Do you want to comment on that?
Sure. So I think that the panel speculated that the market really hasn't fully had time to respond to the tax law changes. The biggest, most important change being the reduction in corporate rates, which makes using U.S. C corporations as a blocker to protect against ECI much cheaper And so one of the big questions is, given the less expensive tax costs of using blockers, whether they'll be more popular, at least among investors who are more conservative on tax issues. I think the speculation is that that in itself may not, because the structures that can avoid ECI are sufficiently good that those who want to avoid it will. The other big point about the reduction in tax rate, though, is that it results in a 17-point reduction for U.S. individuals, so that they can, when they invest in a C corporation, they can defer the recognition of income and realize substantial economic benefits, so long as they avoid the anti-abuse rules for doing so. But there's a lot of discussion about funds being set up for U.S. individuals to achieve that tax deferral, but to date, the market hasn't really developed so as to offer those funds yet.
So from what you've said, it sounds like fundraising can be difficult for a fund that engages in a lot of U.S. loan origination, because the optimum fund structure is so dependent on the types of investors that are being developed during the fundraising process. Were there any takeaways you found most interesting in this regard from the fund structuring panel?
Well, I think the big takeaways were that it's in order to know which structure to offer investors, you have to sort of know up front what the investor base is going to look like. And that's not really always possible to do until you're into the fundraising process. And so successful fundraisers often require being flexible on structure and adapting as you learn more about who the investors are and what their sensitivities are. It also requires educating investors about what the tax risks are that are presented by the different structures, so that they can make informed decisions, and also educating the IR staff so that they can offer the right choices to the investors.
So thanks, Jim. Allison, turning now to you. During the transactional panel at the Credit Funds Forum, everyone seemed to agree on one thing, that this is an incredibly tough market for credit managers with intense competition for investment opportunities. So how can managers be successful in sourcing deals in the face of intense competition?
That is so right, Jessica. When in the survey, and the report highlights this, when credit fund managers were asked to identify their biggest challenge over the next 12 to 24 months, 71% identified increased competition. This is definitely a crowded market. There's a lot of money chasing few attractive opportunities, and the impact on credit fund investments is depressed pricing and intense pressure on credit fund managers to agree to borrower-friendly terms. So the key takeaways from our transaction panel, which had a number of seasoned credit managers participating, is first, how are they coping with the increasingly competitive landscape? Well, first, you need to have a lot of deals to look at in order to generate attractive opportunities. So the focus on pipeline was the first key takeaway. And then the second important point is, well, now that you've seen the opportunities, you have to have some differentiators in order to win those opportunities. So to the first point, having a robust sourcing platform is key, preferably with some sort of edge, whether it be a great network of industry experts that helps to evaluate opportunities quickly and completely, or the relationships that can be created by a credit fund being also a large and long-standing LP in PE sponsor funds that provides a degree of assurance of a robust pipeline of deals simply because of the relationship. And also, even in secondary trades where management might otherwise be motivated to be responsive, that relationship gives a credit fund with a big investment in the PE sponsor that owns the company an edge. Management will take their calls. Another key takeaway is that having flexible capital can be a real differentiator in winning deals. Flexible capital enables credit managers to pivot into whatever structure or security the context requires, so that whether a situation calls for a cash pay, lower yielding senior instrument, or even to the far left extreme, some kind of a PIK preferred structure, A credit fund manager that's able to provide that flexibility, either through having access to capital by having multiple strategies or through having funds with flexible and broad investment mandates, will have a significant advantage in the winning of that deal. Another key element is having the size and scale to be a single source solution if necessary. Even if a credit fund takes down an entire tranche but it ultimately wants to sell down, the ability to speak for an entire facility or tranche that may be upwards of $500 million provides certainty of execution to borrowers that can be a critical decision point for the borrower, depending on the circumstances. And finally, another point, and this goes to winning deals requires a perception that you can be a constructive and valuable deal partner going forward. Having a willingness and the ability to make follow-on loans or other investments and just to be generally supportive in other ways can also be a key differentiator. Borrowers selecting deal partners will, all things being equal, choose to partner with credit fund managers that have a philosophy of being willing to support the company's growth, to be a potential source of needed liquidity in the future, and generally to take an intelligent and constructive approach to bumps in the road. These are all key points that credit managers need to consider when competing for these scarce opportunities.
So thanks, Allison. Another key finding of the report was the interest we saw among fund managers in launching distressed debt products, and the transactional panel that you moderated featured a number of investment professionals who talked about how they were thinking hard about how to be best prepared to take advantage of the market cycle if and when it turns. Were you struck by something similar?
Oh, yeah. Now, we were really fortunate on that panel to have a number of seasoned investment professionals and some advisors who've really seen it all. These guys have been through a downturn, and when faced with the prospect of working through another one, there were a number of key takeaways. The two most important ones that I saw is it's all about preparation. When distress happens, it happens overnight. That point was made again and again. Credit fund managers that have already spent the work to prepare their teams will have a distinct advantage when operating in a distressed environment. That preparation first means educating teams, many of whom have not experienced a downturn. Here at Ropes, one of our most popular client-facing programs is those that help to educate investment teams on key topics in distressed investing, which frankly, we're asked to do at many different levels of sophistication, from the junior to the more seasoned investment professionals. Preparation for these credit managers also means analyzing industries, issuers, individual securities on a granular level now, so that teams are prepared with a view as to what structures and pricing make sense for particular issuers and what the drivers will be to realizing value from those securities in a downturn. And preparation means mentally preparing, too, for the stress of making fast decisions, bucking the market, buying when others are selling. All of those are elements of a successful distressed credit manager. Another key takeaway, really the last key takeaway for me, was that having long-term locked-up capital is fundamental to having the ability to take advantage of stressed and distressed opportunities. Capital that's long-term, patient capital that's either unlevered or that's subject to very low leverage, well, that permits a credit manager to be patient in looking for opportunities. It also enables them to avoid undue pressure to liquidate investments at a less than ideal time and to provide additional liquidity in distressed situations. And that means that they can be part of a solution, which in restructurings is often the critical differentiator between winners and losers.
So, Allison, one participant asked our keynote speaker, former Treasury Secretary Larry Summers, what his thoughts were on identifying when the market would turn. Do you have any takeaways from his response?
Oh, his response was fantastic. What was striking about his response was that he pointed out how consistently inaccurate attempts to predict the timing of a downturn are. He cited an economist survey of 180 IMF historical forecasts that tried to predict when an economy would turn from positive growth to negative. Not one case was the prediction accurate. He was also able to rattle off a number of key harbingers of a downturn, most of all, or all of which seemed already to be true in our current market. So I guess the key takeaway from his response was that we simply will not be able to predict the precise timing of a turn in the cycle. The best we can do is be alert and ready.
Thank you, Allison, Eva, and Jen, and thank you to all of our listeners for dialing in today.